Today, I'll be giving an insight into consultancy, and hopefully by the end of my presentation, you guys will consider it a viable career option, just like I have. We'll be going over these points in the agenda today, and after my presentation, I'll be more than happy to answer any questions you have. So let's get started. So first off, what is consultancy? As a consultant, you're expected to solve problems and create solutions. Clients come to you with business-related problems and seek your advice and expertise. You work with your team to brainstorm and collaborate on a variety of innovative solutions. The best part is, at the end of the day, you're going home knowing that you helped the business. An organization is better off because of the solution you guys made. Here's a SWOT analysis of what it's like to be a consultant. Obviously, there are its advantages and disadvantages. I feel the best part is the work-life balance. After you're a seasoned consultant, you get to set your own projects and set your own hours. You get to network with a number of people from a number of industries, and those connections are very valuable. As with every job, you'll have to make a lot of early career sacrifices. It's a very high-pressure job because clients are trusting you to solve their problems. At the end of the day, all consultants are meant to solve problems. But as you progress further in your career, you might find it that you specialize in a certain area. Here are some of the niche consulting types that are. Management consultants focus more on business growth and structural change. Operation consultants focus more on the supply chain. Financial advisory consultants, well, that's in the name itself. Human resource consultants are often employed by smaller businesses because the smaller businesses don't have the resources themselves to have their own HR department. IT consultants have been quite valuable during the pandemic. They focus on software implementation and digital transformation. IT consultants are really valuable now because businesses are looking to go 100% digital and be as online as they can be. And strategy consultant, the one that I want to be, focuses on making executive, unbiased decisions for companies that determine the direction in which the company goes. Here are some of the big firms in the industry. The firm I want to work at is McKinsey over there. If any of you guys get into McKinsey before me, I'll honestly be quite jealous. As you can see, IBM has taken over the technology side of consulting, and most of the competition is right here in the service side. You often hear the terms Big Four and Tier 1 and Tier 2 firms. There's high competition amongst consulting firms because everyone thinks they have the best tools to solve problems and create the best solutions. Here are some of the job specifications. As you can see at the top, you make pretty decent amount of money right from being an intern. And even when you're an entry-level consultant, you'll have big bonuses up to 80 to even 100% of your salary. And once you're a seasoned consultant, you're making almost as much money as an investment bank analyst. But the best part is you have a better work-life balance. When you're a seasoned analyst, you're probably going to be working 30 to 40 hours a week because you're deciding which clients to take, and you're setting your own hours. But initially, like any job, you're going to be working 60, 70-hour weeks trying to make yourself have a reputable name. There's a lot of opportunities for consultants because people are always searching for problem solvers. You don't need a specific degree to be a consultant. I honestly took economics thinking it would help me with consultancy, but anyone can be a consultant because there's consultancy in a number of fields. I've seen people from the STEM industry, humanities, and so on, and anyone can be a consultant. Now, for the last part. Okay. My greatest strength as a consultant is to be ignorant and ask a few questions. When I was creating this presentation, this was a quote I found, and I feel it perfectly sums up what it takes to be a consultant. There's nothing wrong with asking questions and trying to find out why there's a problem or why even that problem exists in the first place. In the end, as a consultant, you're trying to make a difference, and you are making a difference by helping clients. And if you like the idea of meeting new people, learning about a variety of industries, and putting your problem-solving skills to use, then I'm glad to say you can be a consultant. Thank you.
Anyone have any questions before we move on to?
So, my name is Fergus, and today I'm going to be talking to you about quantitative finance. This is something a career path that I'm personally looking to get involved with. So, if you are interested, you can either ask a question at the end, or come and talk to me, or just send me a message on LinkedIn. So, what is quantitative finance? Well, it's essentially applied mathematics, but it's kind of multidisciplinary. It's a sort of synthesis between mathematics, statistics, computer science, and general finance. So it's kind of an umbrella term, quantitative finance, but I'd sort of differentiate between three key different career paths. Firstly, financial engineering. This is primarily focused on derivative pricing. And there's quantitative analysis, which is about analyzing lots of data, making informed investment decisions, and sort of picking out key insights from the data. You then have quantitative trading, which is primarily focused on algorithmic trading, working close to the money and implementing the algorithms. So a bit more about the different roles. As I said, a quantitative trader is, it's designing algorithms close to the money, which means, you're working like actually sort of executing and doing risk analysis and working very closely with the algorithms. They can be alpha seeking, but there's lots of different strategies you can employ. And alpha seeking basically means you're looking for above benchmark returns. So if you're you're trading Apple stock, your benchmark would be the performance of Apple, and you want to try and execute trades at times when you can get a percentage performance above what Apple is generating. You then have a quantitative researcher. So a quant researcher is kind of the guy that starts off the process. They're primarily an academic that comes into a firm, and they have a rigorous background in mathematics. They will come in, look at a problem, model it, write a paper. This might not be published, but it's within the firm. It's kind of white paper, and then they may even write some sort of like preliminary code. This is then sent to a quant developer who's much more about the implementation. So they will turn this code, this idea, into something that's executable. So they'll take preliminary code that's written in R or MATLAB or maybe in Python and put it into a faster language that can be executed on the exchange through probably C++. You then also have front office people that sort of working a bit more, a client-facing role. So they'll be looking at sort of pricing data or looking at systems architectures, and they can work, for example, at a hedge fund or work for the actual exchange. So again, what sort of things might you be doing? I mentioned derivative pricing, and this is sort of kind of the thing that kicked off the whole quant revolution, which sort of started in the 1970s when Black, Scholes, and Merton discovered what's called the Black-Scholes formula, which is a closed form solution to an option, a simple option. And if you don't know what an option is, it's a kind of derivative where its value is derived from some sort of underlying asset. And so in order to do this, you need to have a good understanding of the mathematics of what the Black-Scholes formula is, stochastic calculus or Ito calculus, which is all about sort of random processes, and then also partial differential equations. So again, it's very math intensive. But you can also do portfolio optimization, which is, it's about optimizing techniques. You can do so much of this in code now. You can work for a hedge fund where they've got, if they're trading a basket of securities, they need to measure the risk of each of these securities and how, correlated are they? And what kind of risk does it bringing a new security into your portfolio do to the rest of your portfolio? So you need to think about those sorts of things when you're doing optimization problems. Model development and implementation, again, this is closer to the money. This is about, HFT, so high frequency trading. Probably most people here have heard of it. It's, something that a lot of hedge funds are doing at the moment. Statistical arbitrage was a thing that was done by a few banks in the 90s. You're kind of looking for like price asymmetries. So if you've got a single security or I don't know, any kind of asset. And if it's traded on two different exchanges, so it's the same product, but it's traded on two different exchanges, they will look for price mismatches. So if the same security is traded at a lower price on one exchange, they'll buy that and then sell it on the different exchange. So arbitrage opportunities, in theory, they don't exist, but firms made a lot of money practicing it. And again, it sort of ties in with high frequency trading because it's something that only exists for nanoseconds. Time series analysis, again, this is sort of the sort of technical quantitative analysis kind of thing. You're looking for signals within the data that can give you informed investment decisions. And then also, you just got to be creative. You've got to come up with strategies that can beat the market. Some of the requirements, I mean, I just pulled this off a random sort of quant job on LinkedIn. And the key thing is you definitely need a master's, if not a PhD, to get into this field. It's highly quantitative, and that's sort of the key skills, the strong analytic skills. You also need a basic array of coding, but it depends. If you're doing implementation, then you need to be a coding wizard. But then, you can't just be, a complete nerd. You have to be able to communicate with people, because at the end of the day, you're working in a business where there are people that, aren't as technical, and you've got to be able to convey yourself and express yourself and sort of get the nuances across. Okay, and so here's an example, because I appreciate, some of this might seem a bit sort of abstract and not very real. So I pulled this example from a conference I attended, and there's a guy called Grant Fuller, who's the CEO of a company called Arithmex, and he was talking about the strategy they researched, and Arithmex sort of interestingly came about as a EU funded project about a decade or so ago to model epidemiology. So everyone's heard of this over the past 2 years. People working in academia building models to try and predict how viruses circulate through a population. And so they recently published a paper on isomorphic agent-based modeling. So it sounds a bit complicated, but essentially what they're trying to do is look at the similarities between funds and, using that data, put it into a model, and that will give them buy and sell signals. So isomorphic basically means, well, it has a rigorous mathematical definition, but it basically means if you've got two or more things, you can understand them as the same thing through their similarities. So what they did was they looked at over 250,000 global funds. They looked at all the data, and then they fed it into this agent-based deep neural network. Now, a deep neural network is a kind of, it's a model, it's a piece of code that learns organically. So it tries to emulate the way that humans learn. So, if you think about a baby, it doesn't know anything, but then it sort of stumbles around the world, parents talk to it, and it somehow acquires language capabilities, cognitive processing. And so this is what the deep neural network's doing. It's being fed all this information, and then it's learning. And what it's learning is it's learning the discrepancies or the similarities between these different funds. And so essentially, once it understands the similarities, it can kind of anticipate what the funds are going to do in the future. And so what this generates is an understanding of the investment strategies and then the capital flows. So this turns into a bullish and a bearish signal. And what you end up with is a heat map. So it looks something like this. This is for Glencore. It's a company that was in the news recently this year for other reasons. But essentially, you can see on the y-axis, starting at the top, you've got the 1st of February all the way down to March. And then on the x-axis, you've got the month of March starting on the left-hand side, going all the way to the right. And what the top row is doing is, this is the output that the model generates. Having been fed all the data about Glencore, it produces this heat map. And as I sort of said on the other side, red indicates reallocation. So this is when the hedge funds are going to sell. So increased supply. If supply is increasing, the price is decreasing. And blue indicates increasing demand. So this is again, this is when demand's rising, so the price is going to rise. And so you can see on the top row, we start off on the left-hand side with a red. So supply is increasing, price is decreasing, and then towards the end of the month, we're going to get lots of these hedge funds that have similar investment strategies buying Glencore. And as you can see, as we go day by day by day, it changes slightly up until the 18th of February, at which point it bifurcates, so it splits in two. And then you can see sort of 22nd of February, 23rd of February, 24th, 5th, 6th, like how similar the signal that the neural network is developing or is producing is to the actual observed stock price in March. And when I saw this, I thought this is absolutely incredible, like, because you're essentially kind of predicting the future. And obviously the model works until it doesn't. And presumably, this is a model that presumably the regulators have and lots of other hedge funds have, otherwise you wouldn't be talking about this at a conference. But it's, this is staggering. So they could do this for all the FTSE 100 constituents for the month of March, month of February, and they do this continuously, and you're generating these predictive signals about the future. And interestingly, I emailed the guy, Glenn Fuller, to ask if I could talk about this, and he emailed back saying, yeah, he'd actually be happy to talk about this. So this could be something we could organise for next term. And so, yeah, that's sort of the end of my presentation. But if this is something of interest to you, definitely do more research. I've got quite a good blog article that I did last year, talking a little bit about the history of quantitative finance. So if you're interested in that, definitely check that out. But as I say, going back to what you need to get into this field is a rigorous background in mathematics. That involves doing master's, PhD, and you've got to make sure that it's rigorous. And when I say rigorous, I mean it's properly mathematics. So it needs, mathematical finance. It needs stochastics, and you need to make sure that it's not a business degree, because the Black-Scholes formula that I mentioned has been around for decades now, and so it's precipitated down. It's sort of now popular culture, and it's very easy to explain what it is, and you can do it in a business program. But to actually understand what it's saying, is a completely different thing. And so, with all that said, that's sort of the end of my presentation. Does anyone have any questions? Yeah.
Is there like some programs at degree, like degrees that are not like just applied mathematics, but like financial engineering?
Yeah, well, there's, in the maths department, there's 4 master's programs. I'm doing mathematical finance, but there's financial engineering, applied mathematics, and does anyone know? Forgot the last one was. Oh yeah, so mathematics, operational research, and statistics, and econometrics maybe. So there's those 4 programs, but I know I think economics do sort of like investing or financial investing. So I'm not too sure, but I know that the mathematical finance program that they just started this year I can testify to it, it's very good. But the financial engineering program's been on for a while. There's, you can do mix and match all your modules, so it's very open.
Is it kind of the same, like the 2 of them?
It's similar. When I was trying to make the decision between the 2, I asked my tutor what's sort of the difference, and he said financial engineering is more focused on research. So if you wanted to go and do a PhD or go into academia, which is a route to go in to become a quant. If you become a professor, you can then do research in academia and then transition over. He said that's sort of a possible route. But the mathematical finance program is more sort of applied. So it's more like a transition from the master's to a job, if that makes sense.
Okay.